Time in the market, ways to approach crypto investing in 2023. 2022 was brutal for cryptocurrency and non-fungible token (NFT) investors. After such a tumultuous year, how should crypto investors plan for 2023? Firstly, this space has critical risks worth considering before investing. Investors must recognize the macro and systemic risks impacting the crypto industry as 2023 draws near. The war in Ukraine has led to an energy crisis caused by sanctions on Russian energy. The crypto contagion from recent bankruptcies continues injecting volatility into the market, with increasing regulatory pressure and minor capitulation likely to continue into the new year. Central banks have tried to address inflation by increasing interest rates, putting downward pressure on equity markets and crypto prices throughout 2022. A possible escalation of the war in Ukraine, with stubbornly high inflation and interest rates, could bring more pain for investors in 2023. The contagion effect caused by the collapse of Terran may still haunt the crypto markets. The failure of FTX in November saw Bitcoin hit another new cycle bottom. Investors should be mindful of this as they enter the new year. Regulatory clarity could help the crypto space in the long run by attracting institutional capital. If a popular stablecoin like Tether, USDT, or USD Coin, USDC, comes under regulatory scrutiny, that could cause market turbulence. If Bitcoin prices continue to fall, pressure on miners will increase. As a result, miners are forced to sell Bitcoin to cover costs, putting downward pressure on the price. Miner capitulation is a feature of previous bear markets and can mark the low point of the bear phase. Aside from these risks, the crypto market never fails to throw in some surprises like Terra and FTX. It offers a general strategy for smart investment that could mitigate risk and limit losses. It helps to keep cash reserves in a bear market, as it is hard to predict a black swan event. Investing in blue-chip cryptocurrencies like Bitcoin and Ether, ETH, is a smart move. The next step toward investing in riskier assets is researching Layer 1 and Layer 2 blockchains, excluding Bitcoin and Ethereum. It might be worth spreading exposure across blockchains that have survived at least one bear market and then looking at new blockchains that sound promising. Before making an investment decision, research and understand the pros and cons of each project. Investing in Layer 1 or Layer 2 blockchains is generally a lower risk than investing in an application. For example, investing in Ethereum is lower risk than investing in an Ethereum-based decentralized finance (DeFi) application like Uniswap. This is because Ethereum has thousands of decentralized apps and its price is resilient to the failure of one application. However, if Uniswap fails, investors in the application will lose their money. This is a general risk management point rather than a criticism of Uniswap. In short, Aptos is to Solana what Solana was to Ethereum one cycle previous. It is hard to forget the Ethereum name service, ENS, and ApeCoin, APE, airdrops in the last cycle and, more recently, the Aptos, APT, airdrop. The Web3 space is filled with new, often credible projects. Investors can get involved in projects early to be eligible for an airdrop when they have a token launch. DeFi projects on Ethereum used airdrops extensively in the previous cycle. 2023 promises to be a year with many new projects being tested. ENS domains were a big hit in the last cycle. As decentralized name services become more popular, it might be worth watching projects developing their own. DeFi had an excellent run in the last cycle. This could be another ENS-like opportunity for the next cycle. It is worth keeping an eye on the investment choices of venture capital funds like A16Z, Sequoia Capital, Solana Ventures, Coinbase Ventures and others. They don't always make the right choices, but their portfolios would be an excellent place to start and refine down to a few good investment candidates. However, investing in new names that are application-tier projects is generally smarter after the crypto market has bottomed and recovered in anticipation of the next bull run. Therefore, 2023 is not a bad time to start, as market prices are low. The longer investors stay in the market and follow the ground rules as often as possible, the higher their returns will be. Despite market cycles and volatility, crypto and NFTs are generally linear markets, and a diligent investment strategy should help generate positive returns. Every investment and trading move involves risk, and readers should conduct their own research when making a decision.